So if you watched the previous video on transaction analysis with the accounting equation, it's now time for me to introduce the 4 basic reports that are able to give unlimited power. Now, each one of those particular reports explains a certain aspect about the company, which reveals certain characteristics. Remember, financial accounting deals with the accounting that's related to the public. So if you think about it, it's a twofold process. We start off recording the information as it happens, and then eventually we take all of that information that we recorded and we summarize the business activities into 4 basic reports, which we call financial statements.
Makes total sense.
So of the 4, they have to be reported in an orderly fashion, meaning that they have one effect to the other. And so with that being said, let's discuss the very first report that must be created. Financial statement number 1, the income statement. Basically, your income statement is a statement that reports income for a period. So what is income? Well, as we saw in the previous video, we know that income is consisted of revenues minus expenses. So we have revenues that are earned during a period, and we have expenses that are incurred during a period as well. And so this is very vital information to anyone because this will tell us whether we have a net income for a period or a net loss. Okay, gang. So here we have an example of an income statement and very simple version of an income statement, but I'd like to share a couple of quick things with you guys. First and foremost, as we mentioned, the income statement represents income from a period. So it's only going to consist of 2 types of accounts. As we have it, we have our revenues and we have our expenses, right? And one of the things that I want to follow up with before is the title. Okay, so for the title, anytime we have financial statements, it's pretty much 3 lines. We start off with our company name. Obviously, the name of this incorporated company is called It's a Joke. This the type of statement, which is an income statement. And last but not least, the period that it represents. So since we are dealing with the income statement reflects income for a period. Therefore, any financial statement that reflects a period has to be classified for the type of period. In this example, we're trying to find out how much income is being generated by this company for 1 month. How do we know that? For the month ended January 31st. So we're particularly talking about January 1st through January 31st, what type of income was generated by this company. So always list your revenues first. And as you can tell, we have a service revenue, which is the amount of $63.60, basically saying that we provide services for generating revenues. Remember, revenues can occur whenever you provide a service or sell a product. This company provides a service, sort of like a tattoo shop. And then next we list our expenses. So let's quickly go over those expenses. You have salaries expense, we have rent expense, advertising expense, and utilities expense. Now notice, gang, that we have different columns in here. We have an outer column and we have an inner column. And basically, we use the outer and inner columns because we don't want to overcomplicate the addition and subtraction that's going on the report. So within this inner column, we're going to just add up all the expenses, okay? So as you notice, gang, we have brackets around each one of these expenses. Basically, when we're reporting and we use these brackets, it basically means to subtract. So what we're doing here, gang, we adding up our salaries, rent, advertising, utilities, and we get a total, which is transformed to the outer column of $53.60. Obviously, we can easily assess that our revenues exceeded our expenses. And so therefore, for this period, this month of January, we have earned a net income of $1,000, which is a good thing, right? It could be worse. We actually had more revenues for the period than we did losses.
So this is fairly a good thing and a good point for the company because we know that we have generated some income for the period. All right?
Financial statement number 2, the statement of retained earnings. So as we already know, retained earnings is a stockholder's equity account that basically represents the amount of income that the company has previously generated or earned and decided to keep it. That's why it's called or classified as retained earnings. Get it? Earnings being income, it's the income that was retained. Now, why would a company want to retain earnings? We should already know this because the company needs the earnings to either operate or grow their business. And so, with that being said, every period that occurs, either we're going to have an income or a loss for that particular period. And so we already know that since retained earnings is the amount of income that's retained, there are certain things that affect it. So the statement of retained earnings basically summarizes the effects of retained earnings for the period. So what does that mean? Well, if we have a net income or a net loss for the period, the net income would obviously increase our previous retained earnings balance. Likewise, if we had a net loss for the period, it would obviously decrease our previous retained earnings balance. And so that needs to be reported. Sometimes when the earnings is retained in the retained earnings balance, sometimes the company decides to distribute that earnings to its shareholders. And we know that in the form of dividends. With that being said, we know that dividends have a negative effect on retained earnings. Let's take a look at a statement.
Here's an example of the statement of retained earnings, and as we already mentioned, our statement for retained earnings shows the adjustments of retained earnings for a period. This financial statement represents a period, therefore we have to label it for the month ended January 30th, which means that for the entire month, this is how retained earnings was affected. Now, because this particular company in which is being reported just started this month, this particular company has no retained earnings for their beginning balance. As we saw in the previous statement, we saw that we earned a net income from the period of $1,000. Well, guess what, gang? This net income will affect retained earnings positively. It will increase our retained earnings balance. Therefore, we have to add it. So what we simply did was transpose the net income of $1,000 from the previous statement directly to the statement for retained earnings. We also have to subtract dividends, any dividends that may occur throughout the period. However, because this company just started off, they did not want to give any of the earnings to the shareholders. They decided to retain the full amount so that they can help grow and operate the business. Therefore, for this particular period, no dividends were given. So we've added up the net income. We've subtracted no dividends that was given. So that now gives us a new ending balance for retained earnings of $1,000. That $1,000 will now go to the balance sheet, which we will see in just a second.
Financial statement number 3, the balance sheet. So before I give you a definition of what the balance sheet is and what it represents, I want you to stick this up here in your noggin. When you think of the word the balance sheet, I want you to think of the accounting equation. So, what does the balance sheet do? Well, it provides us with an illustration of the financial position of the company at a point in time. And so what I want to narrow down on is the fact that the balance sheet is different from any of the other 3 remaining financial statements because they all represent periods. Those periods could be a month, they could be a quarter, they could be a year. The balance sheet represents a point in time in which it was made because, as we know, balances are always constantly changing. So let's look at an example of a balance sheet.
As I said before, the balance sheet is simply the accounting equation, gang. So we remember the accounting equation to be assets, liabilities, and stockholders' equity. Therefore, that will be the only accounts that will be reported on the balance sheet. Quick tip, expenses and revenues do not belong on the balance sheet. Right now, there are only two accounts that I want you to focus on that pertains to stockholders' equity. That's common stock and retained earnings. And yes, we already know that retained earnings is affected by other accounts, so don't make that mistake of transposing revenues and expenses on this balance sheet. So as we can see, we have our assets listed. They are in a particular order, but again, as of right now, we're not going to discuss that. We're keeping it simple. All I want you guys to focus in on is that our total assets are $39,500. And then next, we list the other part of our accounting equation, which consists of liabilities and stockholders' equity. So we separate and report our liabilities. And as you can see, we have several types of liabilities. Accounts payable, salaries payable, utilities payable, notes payable. Remember, gang, I told you 90% of the liabilities' last name will be a what? Payable. So definitely pay attention to that. So we have a total liabilities of $14,600. And so now we go on to report our two parts of stockholders' equity. Again, stockholders' equity is broken down into two parts, paid in capital and retained earnings. Paid in capital is simply just the funds generated from shareholders. And our account that we're going to focus on through paid in capital is called common stock. So we list our common stock, $23,900. And retained earnings. Let's focus on this retained earnings. Does that $1,000 look familiar, gang? It should. Why? Because as we said and as we already noted, that we're going to transfer our ending balance from our statement for retained earnings to the balance sheet. So this is where it lies, right here. This retained earnings, $1,000, represents our new ending balance from the statement of retained earnings. So everything connects, gang. And that's exactly what I told you guys from day one. That's what makes accounting so beautiful. And so once we add up our total stockholders' equity, we get a number of $24,900, of which we have to add that to our total liabilities. And that gives us thus a total liabilities plus stockholders' equity of $39,500, which happens to equal our total assets, thus creating in full a proper balance sheet. Now, the last thing I want to quickly note, so look at how the title classifies the date. It doesn't say for the month ended, for the period ended, it just says that date. Why? Because as we know, this balance sheet is only effective as of the time that it was created, which happens to be January 31st.
Last but not least, the cash flow statement. So basically what the cash flow statement does is summarizes cash inflows and outflows into three major activities. Inflows being cash coming into the business and outflows being cash leaving the business. This is very critical and important for a company so they can know how they're using the cash. What ways are they using the cash to come into the business, and what ways are they using the cash to leave the business? How are they spending the cash, and how are they actually earning the cash? So let's look at the cash flow statement.
And so last but not least, I want to briefly introduce to you guys the cash flow statement. Now again, this video reflects an introduction to financial statements. Now we're going to get in the nooks and crannies of each one of these financial statements at a later point in time when you guys are ready. So basically this statement summarizes all of the cash flow activities for a period into three categories: operating activities, which are the first, investing activities, which are the second, and last but not least, financing activities. Each one of those activities will report whether an inflow or an outflow. Inflow meaning money coming in, outflow meaning money going. So for our first operating activity, we had an inflow from customers. So we received some cash from customers of $5,100. And then we list our outflows. Now again, when we're doing financial reporting, when anytime you see brackets by numbers, right, that simply means to subtract. So that's basically saying that these outflows were cash spending, right? So we spent some money on salaries, we spent some money on rent. So those are considered outflows, and that's why they're being subtracted. Then once we get our total outflows, we then just add up the inflows and the outflows from the period. And as you can see from our operating activity, we have a net cash flow from operating activity of $3,700. And that happens to be an outflow because it's a negative number. So we paid more cash than we did receive. Next, let's move on to our cash flows from investing. The same thing, we're just summarizing. And so for our investing activities, we have a cash outflow of $24,000. Again, we know it's a cash outflow because it's negative. So we spent some money on purchasing equipment. Then we move to our financing activities, okay? And so our financing activities fortunately only had cash coming into the business. And so we had two inflows from our financing activities. Basically, we received some cash from issuing stock for $23,900. And we actually received some cash from borrowing from a bank of $10,000, okay? So our total cash inflows from financing for the period was a total of $33,900, okay? So what we do is we add up all three of those cash flow activities. We're talking about the 3,700, the 24, and the 39. And that gives us a net increase of cash of $6,200, okay? Now, the reason this is in red, gang, because this is the exact same amount that was transferred from the balance sheet. This is our ending balance in cash. So basically what we just did was summarize how we got to that ending balance of cash that was on the balance sheet. This is a very critical financial statement because it lets us know what the company is doing with its cash.
So there's basically a connection from the income statement to the statement of retained earnings to the balance sheet. Likewise, you will transfer that cash balance off the balance sheet to the statement of cash flows as well. Thank you for watching the video, and if that light bulb clicked, don't forget to like, subscribe, or share the content, and look forward to more Accounting is a Joke material that'll help you chase the bag.